Good morning. Today is April 1st, 2026. I'm Joe Terrill, president of Terril and Company, private wealth managers headquartered in St. Louis, Missouri, with approximately $980 million of discretionary assets under advisement. This is another update on our thoughts on the economy, interest rates, inflation, and certainly the markets. To say that it's been a volatile month of March is very much an understatement. Between weather in February and March, between this war in the Middle East, computerized trading, all things that I want to ask our investment committee here at one time or another to address for your benefit of maybe understanding. It has and is something to see the continued volatility. We talked about at the end of the year in particular, and even in previous videos, that we believe this is the type of economy and investment markets that scream, be careful, be cautious. That was certainly correct, and for the moment I think you're going to find out we continue to believe that's a good scenario. But to get started, I want to mention that we've also said longer term interest rates are not going down. If anything, they're going to go higher. And that happened during the quarter. So Dave Carter, let me start with you if I can. Talk about maybe what happened in fixed income markets in general, and how much did interest rates go up, and for other bond market investors, what that mean for them for the quarter?
Well, in general, the longer duration, bonds, if you had positions in long duration bonds, you're down, maybe 1%, and that's after your dividend, after your coupon, or more. The market is now expecting no rate cuts from the Fed, and since the Fed had started their rate cut process, the 10-year bond is up from a 365 level to a 430, 440 level. And it's been very sticky.
But we had some days there where a 10-year bond was hitting close to 4.5%.
Yeah,
again, the bonds have been very volatile.
The markets have been very volatile, including the fixed income markets. But ultimately what we're seeing is we're seeing the yield curve steepen, meaning longer rates are going up while short rates are not going down. And also we're seeing spreads widening, where treasury bonds are the risk-free asset. We're seeing spreads on corporate bonds increasing. And so the market's pricing in a little more risk, but that's good for us, because now we can get some more yield.
What would you guess our duration is? I think our average duration, because of the reset paper we own and the incredible amount of short-term paper, can't be more than 18 months, can it?
I would say 2 years, but I would 18 months to 2 years, and the reset paper all have pretty good coupons on them, and this significant majority of them are tax advantaged, and so that's another benefit.
But we had positive returns in our fixed income because we have kept the duration short. I know
Correct. Yeah.
March 31st is yesterday, and we're still auditing and putting it together. But I'd be very surprised if we didn't have gains of 1.5% type gains in our fixed income.
The index that the market uses for the quarter is down 25 basis points, and that's just a broad, that includes mortgages and treasuries and corporates, and it's a very broad indication of market. But our portfolio, fixed income portfolio, will show a gain in the quarter.
And it's our intention to keep these durations short, at least for the immediate future. So
Absolutely, and
I get back, and you know, the rest of you can speak up if you want, but I get back to the amount of money that has to be borrowed by governments all over the world. How are we in the United States going to borrow $2 trillion without offering a higher interest rate to compete with Japan and other countries all over the world that are borrowing tremendous amounts of money?
and what we're seeing right now also is we're seeing some of these central banks selling U.S. treasuries for, for their own, whether they're supporting their own currency, whether because oil is now $100 a barrel, because they need to buy oil for their country. So, that's also playing into it.
Well, our outlook there, short-term interest rates have crept up a little bit. We've been able to buy one-year paper at very attractive yields, both tax-free and taxable. And we still think longer-term interest rates are going to continue to go higher. They're not going to surge higher, but they're going to move higher. And that's been correct. But Dave, thank you. Let me switch in the time frame.
But just real quickly before we move, one of the things in the rate markets that we're also watching is the private credit situation. And that's, and I think that's one reason the spreads are widening. But, it bears watching.
I'm going to ask when Russ comes your time to explain to people what we're talking about. A lot of our viewers don't understand how much money has been lent by non-financial institutions, but that's going to be one of the things I'm going to ask you to explain. But I'm going to turn to Bill right now. Bill, just give people a general idea how volatile equities have been. And by the way, for the March 31st first quarter of the year, we will be in the green. It's just a matter of maybe the composure of the stocks that's in your portfolio. But while stock market's, on average down 5%,
Yeah.
Would you think?
Yeah, I think, Joe kind of hit it early in the introduction that, we generated positive returns in Q1. Most of the stocks, depending on what indice you look at, are down between 5 and 7%. I think it's helpful for our clients to look back and to reflect a little bit about what we've seen over the last 5 weeks. So all of this volatility in the market is generated by computers. You may often see it referred to as algorithm trading. That's just a fancy word for computers doing all this. It's fascinating to watch and maybe even a little gut-wrenching, but it's not fundamentally driven, right? It's mostly headline driven. And the war in the Middle East has given the computer traders a lot of reasons to trade. So it's very volatile. We've been taking advantage of price dislocation. So if a stock, runs up in this market, we'll trim it back or sell it. If the price gets too low, we'll initiate positions. So that's probably not going to change, but we would just remind investors that all of this is very reactionary. It's not fundamentally driven. So when we look at our names, Disney and Solventum have both had, pullbacks, maybe unfairly, but those are two names that we like, and we'll be looking to add to those on any price dislocation.
Bill, I thank you. Because our overall investment philosophy really does start at the macro level, which means the economy. And Kristen, you have been reading quite a bit about the economy and recent economic statistics, plus all your own observations. So I'm going to ask you to, overall, our outlook for the world economy is still positive, and we're not seeing horrible economic statistics come out yet, but Kristen, talk a little bit about some of these statistics that did come out and explain to our viewers why some of those statistics didn't look as good as what we would hope for.
Right. Well, I'd agree. People are still spending a lot of money. Most would argue we are in a K-shaped economy right now, which basically means lower income people are cutting back, but the main drivers of the economy are still middle and upper class. They are still dominating the economy. They are still spending money. I know there was some poor economic statistics, and I think it was heavily weather related. We had horrible weather across the entire U.S. People were stuck in ice storms. I mean, even here it was terrible. People were going out, you know, you're not shopping the strip malls. You're not going out and buying cars. You don't want to go, you don't want to go look at the houses, and, you know, that kind of puts a stall on things.
So, Kristen, the people that are spending money, do you think, from what you can read and observe and be out there, that higher gasoline prices are going to make everybody watch TV and stay home and stop spending money?
No. I think people will still do their day-to-day, still go out. Now, maybe lower income, there's a little more, cutting back. But I think, most people would agree, you hate when you sit down and budget and say, hey, we're spending too much money, let's cut back. It's the last thing you want to hear. So, as I was telling Joe, I think a lot of people are picking up, as we call it, side hustles. Or you're selling more on eBay, Facebook Marketplace, selling things on Etsy, even making a little side income, $500, $1,000 a month. Well, you can continue your spending, and then everyone's happy. And there's a lot more dual income households now. We come from a time where there was just one person working, and now there's two people, and we're seeing the effects of people spending money on dual income households. So the spending will continue.
And speaking about, I'm sorry, excuse me a minute. I had an Uber driver the other day tell me the same
Uber.
thing. And he said, yeah, there's a little more drivers out on the street now because if the economy's a little bad, some people are saying, well, I think I'll go out and drive Uber for 4 or 5 hours to try and make the extra bucks so we don't have to cut our budget and cut back on our spending.
And you can pick up and do that whenever you'd like. I know quite a few moms will do it after kids go to sleep, and hey, you can pick up people that are going out to the bar. You make good money doing it, and hey, if you're staying at home or you have no income, and $500 extra a month is great. You can continue your spending.
Kristen, thanks for your update. Russ, I want to get to you, and maybe, Russ, you're very good as a technician and et cetera. Talk overall about the things we're talking about. Inflation, we still think is going to be in that 3% range, that inflation isn't getting ready to drop, but give us a little bit of view overall of the things we've been talking about.
So let's just break it down to 3 things. We talked about the economy. In our view, the economy still remains in good shape, right? You see people spending money, as Kristen said. One point I was going to make on the economy and the offset to higher energy prices, been looking at a lot of client tax returns. We mentioned this on a video prior. The one big beautiful bill in the senior tax or deduction that's being provided is an offset to the higher energy prices. So where you might have had extra money to spend, like Kristen, now you may be putting some of that into the car in terms of filling up with gas. But on the macro side, we continue to believe the economy is doing well, people have jobs, and they're going to spend money. I think David did a nice job on the interest rates. I think the steepening of the yield curve, you are seeing that. I think we've discussed, Joe, a lot about, you mentioned the borrowing, right? What is the war going to do to our cost? It's not gonna bring them down, right? I mean, so I think we're gonna have to continue to find people that wanna own US Treasuries, whether that's domestically or, foreign entities. And then finally, as far as stocks, if we would have sat here, we did make a very smart decision to remain cautious coming into this beginning of the year. But if I were to tell you that energy stocks year to date, as represented by a sector in the S&P, are up 37%, I don't think anybody here would have thought that. Energy, materials, and utilities as a sector have done very well. On the other side of that, you mentioned private credit. I'll give you a short definition. Private credit is basically non-bank lenders lending to private companies is the best way to describe it. And I think a good reflection of what's going on, good or bad, financial stocks, as far as the S&P subsectors, are the worst performing, down almost 10%. You got consumer discretionary and tech. Excuse me. Part of that private credit, and we've looked at it a lot, software. Software stocks have really gotten beat up in this environment. The almighty Microsoft, from its highs, is down roughly 20%. Nvidia down. So technology stocks, especially software, have been beat up. Moving forward, we're looking, as Bill said, at those dislocations. We're looking at the fundamentals, looking for opportunities to allocate capital for our clients.
Russ, thanks. Brian Curtis, we maybe went a little longer than normal. I hope it doesn't create any production problems for you to get this posted on the internet. And we thank you for viewing today's video. And we were a little lax in March with all the activity. And as Kristen mentioned, weather, we missed 2 or 3 days here in the office because you couldn't get to the office because of the ice and bad weather. But we will be back. Sorry?
Happy Easter.
Yeah, a very happy Easter to everyone, and thank you for tuning in. Thank you, Brian Curtis.
Thank you.
Thank you.